Good afternoon, everyone. Thank you for joining us. We are going to give it just a few seconds here, maybe about a minute while people gather in the room, and then we will begin today's discussion. In the meantime, if you are a sponsor, feel free to raise your hand. Raise your hand. There's a button at the bottom of your screen so that I know who you are and I can navigate to you effectively when we do these sponsor introductions. Okay, so as people are still coming in the room today, we'll begin. Thank you all for joining us. We have a great discussion today surrounding M&A originations during a pandemic. Very exciting and odd times. Looking forward to getting to that. But before we do, of course, I have a couple housekeeping issues I want to get through. My name is Lena Dobrier. I'm the Director of Operations at Opus Connect. For those of you who aren't familiar, we are a lower middle and middle market focused organization catering to transactional professionals in the M&A space, specifically private equity firms, investment bankers, independent sponsors, and lenders. We are membership based with chapters in LA, Chicago, and New York, where typically we would be doing in-person panels and roundtables each month in each chapter. And in addition to those events, we do our deal sourcing events all around the country. Given the current climate, we have made the shift to virtual. And so if you're interested in learning a little bit more about us and the kinds of events that we put on, feel free to reach out to my colleague, Jacob Zeffrin. His contact information is at the screen below there. He'd be happy to answer any questions. Now, today, our panelists will probably be taking live Q&A. So as questions come to mind, please, at the bottom of your screen, you'll see a Q&A box. You can type in your questions there. Our moderator, Nick, will be monitoring those and fielding those. We'll try to get to as many as possible, but please submit those there. These events, of course, would not be possible without the support of our sponsors. So I want to give each a moment and acknowledge them and allow them to introduce themselves and their firms if they are here. If they aren't, it means they're busy, which is good. So NFP, longtime insurance sponsor of our New York chapter. I don't see Duncan in the room. If anyone from NFP is in the room, please raise your hand, but I definitely want to acknowledge them. His contact information is not there, but if you have any questions, nfp.com, or reach out to us and we can put you in touch with the appropriate person. Moving on to resources, is Nick in the room? Nick is not. Same thing there. I want to give him a shout out and acknowledgement and thank him for his support. We'll move on to the next, Ice Miller. If we were not doing this virtually, we would be in the Ice Miller offices in New York. So Chase Stewart and Tom Kessiglu, longtime supporters and friends of Opus Connect. Their contact information is below. Please reach out to them if you have any questions. And then last but not least is Focus. And I don't think Steve is in the room. Focus Search Partners, executive search. They work with a lot of private equity firms. Reach out to Steve if you're interested in learning more. Before we get to the discussion today, we have a couple poll questions that we want to ask the audience. This is helpful for us to know how you heard about the event, and then we have another one that'll tell us a little bit more about who you are. So we're going to go ahead and launch that first one. Please let us know how you heard about today's event. Are we doing well on the marketing side? Did you hear from us, our sponsors, our speakers? And judging from these initial responses, looks like we have a good mix. We'll share those results in about 5 seconds, and then we'll move on to the next one. Great. So the team at Opus, we're doing our job. Our speakers, thank you for your support in helping to promote, our sponsors as well, and LinkedIn, thank you. The second question is helpful for us, but also helpful for the panel to understand who they're speaking to today. So let us know which best describes you: independent sponsor, investment banker, capital provider on the debt or equity side, service provider, or other. We'll give it about 10 to 15 seconds and then we will move right along. Great, let's share those results so our panelists know. 10% independent sponsor, 31% investment bankers, 10% capital provider on the debt side, 23% on the equity side, and 19% on the service provider side, a few in the other. So that's awesome. Thank you guys for participating. This will be helpful as we get to the discussion, which we are going to do now. Without further ado, I'd like to introduce Nick Berry of Clearview Capital, today's moderator. Nick, take it away.
Great. Well, thank you, Lena, and thanks to Opus Connect for organizing this event. Good afternoon or good morning to all of you, depending on where you're signing in from. We have over 135 registrants, so I think this will be an interesting discussion today. My name's Nick Berry. I'm a principal at Clearview Capital. We're a generalist private equity firm based in Connecticut. We focus on control and non-control investments in North American companies with 3 to 20 million of EBITDA. I've spent 7 years originating investments for Clearview, and excited to discuss this important topic of M&A originations with you. Like most of us in M&A, we're used to flying to conferences, to taking people out for coffee or for lunch, stopping by our Referral Sources office. So how do we as private equity firms, investment banks, lenders continue to develop new business amid restricted travel and a pandemic? Despite all of this, there are new deals hitting the market. The M&A market is alive. Pitches are moving forward. Engagement letters are getting signed. Deals are getting closed and companies are getting financed. So many of these processes, would love to touch on this later, but are smaller, condensed. So it's perhaps even more important to focus on business development and your relationships. So with that backdrop, I'd like to introduce our panelists. Dan, I believe you're up first. Would you like to kick us off and give us a brief introduction?
Sure. Thanks, Nick. Great to be here. Hello, everybody. I'm Dan Lee. I'm with Comvest Partners. We're a private equity firm based in West Palm Beach with 2 strategies. We've got a lending arm where I'm a partner, and our private equity side, which is investing for control. We're typically investing in businesses with 8 million of EBITDA and above, deal sizes of 20 to 150 million per transaction. We also, I will mention, are building out a strategy which is focused on more junior capital rescue financings. We're seeing a lot of activity there. So that's an area we're excited about and happy to be here and looking forward to learning with you guys.
Great. Beatrice? I think you're on mute there, Beatrice.
Sorry about that. Hi, and thank you, Lena, and thank you, Nick, for inviting me to be on this panel. Sperry Mitchell is a small, privately held investment banking boutique. We do one thing, which is to sell privately held companies. We've been around for over 30 years, and we do probably 8 to 10 deals a year in what we call mid-market. So probably minimum of 3 million EBITDA and maximum 20. Most of them are probably in the $5 to $8 million range.
Excellent. Great. Thank you, Beatrice. And just to give you additional context, Beatrice was recognized as one of the most influential women in M&A by Mergers and Acquisitions last year and has a number of similar recognitions. So glad to have you here today.
Thank you, Nick.
And Doug, I believe you're next.
Thanks, Nick. Yeah, this is Doug Sutton. Pleased to be here today with everybody. I'm with Huron Capital. We're a Detroit-based private equity firm. Been around since 1999. So in those 21 years, we've raised over $1.8 billion in 6 different distinct equity funds. We're investing today out of 2 different funds. One is our 5th traditional buyout fund, and the other one is our flex equity fund, which I manage, which focuses on non-control investing in the lower middle market. Our check size is 5 to 20 million. We usually in the flex equity will take between 10 and 49% ownership. And we partner with privately held businesses or other investors to provide liquidity or growth capital. EBITDA ranges 5 to 20 million for starting point, which is the same on our buyout side. Probably starts with 7 or 8 million of EBITDA and goes up from there.
Great, thank you, Doug. And Ken?
Thanks, Nick. Hello, everyone. This is Ken Heuer with Kidd & Company. We're a family office based in Greenwich, Connecticut. Our goal is to make control investments in businesses in the lower middle market. Businesses we typically desire are between 2 and 10 million of EBITDA. We're typically looking to partner with incumbent business owners in a strategy where we can give them not only a liquidity event, but an ongoing operational role alongside us as we look to grow and scale their business and take it to a level that they would not have been on their own. So we're truly generalists and look at a lot of different companies. In my role at Kidd, I do everything from originations through to actively managing the portfolio companies.
Great, thank you. So to start things off, I'd like to just do one additional polling question. This, I think, will be interesting to hear what the audience says, and this is really about when you think you're going to be actively traveling again for business. So there's a brief question here, and if everybody can just give a quick estimate on when they think they're going to be traveling again for business purposes. Okay, we'll give that another second or two. And Marisol, are you able to show the results from that poll? Interesting. Okay, so it looks like just under a third say Q4 this year, just under a third say Q1 next year, and about 17% Q3 this year, and some Q2 or even Q3 or later for next year. So that's interesting. I think there's going to be a mix of people that are going to travel for new deals as well as marketing purposes. So Ken, I'd just kind of start with you. How do you react to the M&A market, and whether different constituents are not traveling, and do you think that's going to be geographically dependent, or people will travel locally more? What are your sort of initial reactions?
Yeah, my sense is it's the getting on a plane and staying in hotels that's the real barrier to travel. So, being in the Northeast, I think anything within driving distance is certainly, even at this point, fair game with the proper precautions and social distancing. So we've looked at a number of opportunities, within driving distance of the New York area, and believe that that's where we'll start, and then kind of branching out from there. It's still hard to think that you won't need to see a business to really engage with the business owners, and particularly when we're looking to partner with these people in general, going forward and develop a strategy and a relationship, needed to do that in person is pretty important and paramount.
And how about from a business development perspective? I know some contacts that are playing golf or meeting for, it's not too far-fetched to say you could meet for an outdoor coffee or meal. What are your kind of personal, and this is for everybody here, but personal take on when you think that might really be more commonplace?
Yeah, we've the past 2 months or so, we've really ramped up our buy side efforts, working with a couple of firms in particular for executive introductions. So these are people that have had a career in the industry, in whatever industry they operate in, and potentially have a lead or an interest on getting back into running a smaller company. And so not only do they have the potential to be our eyes and ears into interesting business segments, but also have a lot of pre-existing relationships with business owners if they're not sitting in that position currently. And so, you know, our thought process is spending time with these executives is a way to get kind of one step removed from some of the business owners directly. And hopefully that'll evolve into something where we get further down the path, and that coincides with when we're willing and able to get back out on the road and meet with these companies firsthand. So it's been a way to feel like we're being productive and exploring some new opportunities. Otherwise, you've really been a lot of just, you know, kind of dusting off the existing contacts, staying in front of bankers that have deals. And, you know, we've participated selectively in a few, you know, more broad sell side processes, and that's not our typical preferred way of buying businesses in a good environment. So that really hasn't changed. I mean, good companies are still going for high valuations in today's environment. So it's not productive for us to spend time there even now. So we have to be a little bit more crafty and creative in how we get out there.
Okay, great. So Doug, I know that you guys do a really good job covering the market. What have you guys done at Huron to, you know, to adapt and kind of strategically adapt to, you know, to this environment in terms of a business development perspective?
Yeah, I think we're like a lot of people, we're not traveling as we had in the past, certainly for business development. So been a lot of focus on virtual deal sources, virtual webinars, and good old fashioned phone calls. The strategy's shifted a little bit. I mean, we're maintaining relationships with our existing friends. It's a little bit harder to develop new relationships for sure virtually. We've been spending a little more time talking with lenders and turnaround consultants, because we think they're going to have some clients that are going to need some capital. But generally, I would say the efficiency gains for not sitting in airports and not traveling from office to office is tremendous, and the cost savings. We're saving probably $100,000 a quarter just on travel expenses. So, and if you really do arrange your meeting times, you can be very efficient. You can schedule 8 meetings in 4 hours, and actually our number of meetings as defined by, you know, one-on-one conversations is up 25% this year because of the efficiencies.
And do you think those changes will be long lasting, or, you know, will we flip back to, you know, to jumping on the airplane and you know, trying to see people in person, or will there be a mix?
That's a good question. I do think behavior is going to change from this pandemic. I think there will be more virtual meetings. You know, I think people are getting tired of Zoom calls, but they are effective. Now, with that being said, I don't think you can replace, you know, good old-fashioned face-to-face meetings and breaking bread with somebody. So I think that will come back, but it might be, you know, it might be until next year.
Yeah, and you know, Dan or Beatrice, I think it's an interesting question that Doug brought up about sort of existing relationships versus developing, you know, new relationships. You know, personally, I haven't been really taking the cold calls as much. You know, for people that are reaching out to me, it's harder. You know, if you think about it, to connect with someone without maybe the in-person or just a, you know, different sort of context. So how do you view sort of your time over the last couple of months and then the next couple of months in terms of existing relationships, referral sources, you know, and developing new ones?
Beatrice, you want to take that?
Sorry. Well, we're always being called. We have the goods, right? We have the product, so we're always. I don't want to say popular, but we're popular, and everybody's always calling us to look for deals, and that has only accelerated now. We are taking new calls from people who call us. Why not? And in a way, of course, it's much easier because there's no commuting. There's no, you get on do your calls, and at the end of the day, it is a much more efficient time. So.
Mm-hmm.
But you're right. I think the in-person meetings are better. And my guess is as soon as it's possible to go back to in-person meetings, people will start to want to see us in New York and want to see us when we're traveling. And we will go back to traveling, and we will go back to taking in-person meetings. But that may be a long time from now.
And how about your referral sources, the accountants, attorneys, wealth managers that you keep in touch with to get referred into potential capital raising opportunities, former clients? How do you, how have you been keeping in touch with them?
Same thing. A lot of them call us. We call them. There's sort of a group of core people that we always stay in touch with, and we've continued to do that. But I would say in general, referrals are definitely down, understandably. It's a troubled time, really, and sellers are very unsure as to what to do. I can speak about that later if you want.
Mm-hmm. And pitch activity, are you mostly mining through your existing pipeline of clients that you originated pre-pandemic, and now you're sort of working through that, and you're also pitching a new business as well?
We're really. Listen, as a small private company, we really can be, I think, be extraordinarily honest with our clients. And so for most of them, we're saying, look, we don't believe buyers are going to really price you on the COVID add back. They're going to want to see that you actually recover. So we're putting a lot of processes just on hold and saying, let's get through year end. Let's see what happens. Let's see if you really do come back. Different from 10 years ago when sellers weren't as sophisticated. Now every seller knows what EBITDA is. Every seller knows what their multiple should be within their industry. Every seller knows there's a lot of money out there. So I'm not going to go to market with somebody who thinks he should be getting the multiple off last year's earnings. It's going to be sort of fruitless and frustrating process for everybody. So we have 3 or 4 deals that are in letter of intent stage or in closing stage. I hope they will close. And then there are a couple of very attractive companies, but we've said, really, let's get through the year and see how you look January 1. And then let's talk about going to market.
Do you think you're competing with some investment banks that are saying to those same clients, you should go to the market, and there's a window now, perhaps before a second wave, and you should go to market?
I could be, absolutely, I could be, but I don't think. There's so much pent up demand on the part of private equity groups right now. It's just a tremendous amount of money out there. So I don't think this money is going to disappear in 6 months. And I do think, despite what private equity groups say, look, when this all started, a lot of groups who never had done this before called us and said, hey, let's see who's distressed, show us what's distressed, that's what we want. That's not what we do, so we didn't do that. Now we're getting back to show us what you have, we'll do an idea, we'll price off, maybe we'll consider adding back everything from COVID. But honestly, do I really think they're going to do that in due diligence, especially if they can't visit, and especially if the Q3 numbers come in poorly? No, I don't. That's just me. I tend to be concerned. Probably other investment bankers feel very differently. I'm sure they do.
Yep. And Dan, how about, what's your experience? What companies are getting financed today? And, can you share more about kind of what your focus is for new business, what's worked perhaps, and what maybe is not as effective?
Sure. Yeah. So I think for April and May, it was cast a wide net. The deal flow was so paltry that it was really just reach out to everyone you can to let them know you have money. And I think half the people I probably set up calls with thought I was calling them for a job. It was sort of like, what are we talking for? There are no deals getting done. So what's the point? Right. And once we got past that awkward part, we had a conversation about what we thought was going to happen in the next few months. But I would say June and July, we've seen a big uptick. And in particular, we're seeing an uptick in junior capital, rescue capital, kind of bolster the balance sheet. which I think got kicked down the road a little bit by the PPP and cost cutting by companies. From a business development standpoint, what I've found to be effective is after casting that wide net, focusing heavily on existing relationships for sure, making sure that we have those covered and they know that we have capital and that we're here to price risk, but also figuring out where's that next ring of the circle where the guys that didn't need creative capital 6 months ago are now more open to a little higher price with more certainty. And so we're finding that in April and May, we were finding that I was getting calls from a lot of people that I don't normally hear from because no one was in business or very few lenders were in business. In the last couple of months, a lot of lenders have come back as they've realized that their portfolio companies aren't going to need all of their dry powder and they can start thinking about doing new deals again. So pricing is definitely tightened in the last couple months. Structure has loosened a little bit from where it was, but it's still very early. Very little M&A activity, very little M&A activity, but certainly picking up from where it was, and 2 weeks ago, certainly a month ago.
Yeah, I guess Doug and Ken, what have you guys experienced from, sort of week over week or month over month, new deals in your pipeline? Have you seen a pickup in the last, say 4 or 5 weeks?
Yeah, I'll go first. Yeah, for sure. I mean, if we ignore March, which was pretty dismal, our year-over-year deal flow is actually up, and May and June were ahead of the previous year. We've had more NDAs signed and more activity. The question we always ask, there's two questions. One is why would a deal come to market now? What is what's the underlying cause? And if it's something that needs a liquidity, some kind of liquidity, is it a good company that just happens to have a bad balance sheet, or is it a bad company? So those are the two questions that we're asking when we see deals. And there are some logical reasons why some businesses are in the market, and we're trying to pursue those. I would also say, sorry, Ken, one other quick thing. I would say that the comment about deal flow is really on the non-control side. We're seeing more structured equity opportunities. I think our buyout side is still behind last year, and while deal flow is picking up there, it's still not kind of where it has been in the past and where we think it will be coming. Sorry about that.
Yeah, no worries. What I would add to that is the stuff that we're seeing come to market by sell-side bankers is fairly high quality in that they can point back and say they were relatively unimpacted by the pandemic and have a strong visibility to the rest of the year and beyond, in which case we're finding that things that we're interested in, whether it's an add-on acquisition or a new platform, we're actually getting pretty dramatically outbid on. And so it harkens back to, why would we spend our time just looking at sell-side opportunities? Because for assets, unlike some of Beatrice's clients where people are advising them, just wait until you've got that visibility. If the visibility is there today, they're coming out and we're not competitive. And so, as I mentioned earlier, some of the things that we're spending more time on than we maybe have in the past is buy-side activity, which is just by design going to have a longer tail to it. So it's nothing, even if we start a new relationship today, maybe we'll be in a position to look at closing something late Q3 or Q4, whereas some of these sell-side processes are still, holding a pretty short fuse. They're going out wide. We're one of 50 people looking at a book. They're getting 20 IOIs or more. And so it's pretty frothy for good, high quality assets.
Yeah, that's an interesting observation, Ken. I would echo that. We've seen a lot of high quality companies, probably to Beatrice's point, that those companies that are doing well now aren't waiting. But if you do have a 20, 10, 20, 30, 40% reduction, impact from COVID, perhaps it just does make sense to wait. So Ken, on that, when you are speaking through the buy side, what is your what is your response rate? Do you measure that in terms of how effective your buy-side intermediaries are with contacting companies? And curious if that response rate has increased or decreased in this time.
We probably don't track it as religiously as we should. So I don't have a comparative metric to times of past. It tends to be more industry specific and strategy and executive specific. So we are getting a certain amount of calls, and some of these are earlier days, so we haven't done the broad outreach on the specific targets yet. Some we're in discussions now where an executive has a target in mind or kind of pre-screened it, and it already had some preliminary price talk and valuation discussions. So we focused on those as opposed to just going into a database and cold calling targets yet at this point. So I think it's too early to know success rate on level of interest of targets, but I think what you're going to find is certain industries are still pretty frothy and have high valuation expectations, and it might be harder to reach a meeting of the minds on traditional valuation metrics. I think to the extent we're going to get anything done that's new or has high expectations, it's going to have more structure, more earnout, more variability in how we'll come to a meeting of the minds on valuation there.
Yep. And to that earnout question, I guess for everyone here on the panel, have you seen a lot of structure in current valuations? How do you think about deals that are getting done now? Obviously you have an interesting question of COVID impact, and then you've got an OpEx question of how much companies have actually cut costs effectively. And to Doug's point about less travel, companies are spending less on their marketing budgets too. So you could also have inflated earnings. But so interested to hear what you guys think about earnouts and structure and valuations today.
I want to try. So Nick, we were working on one that we felt like pre-COVID, we were working on it pre-COVID, and we felt post-COVID that the structure did require an earnout. There was the uncertainty that was in the marketplace and uncertainty in some of this company's end markets. And so we proposed that, and it wasn't accepted, and the deal went away from us. So it's more difficult now with the public markets kind of being up where they are. It's harder to sort of come back to a private transaction and say, yeah, it should be a 20% discount from pre-COVID levels, even though I feel like the uncertainty is out there. As somebody's already said today, there's still a lot of money chasing deals, and we aren't necessarily seeing sellers' expectations changing that much. So we believe that structure is required in these transactions. But I would say that we're not always seeing that happen.
So I might just add that, yes, we're seeing deals that we had signed letters of intent. The buyers are coming back and adding, and often adding an earnout, and we're pushing back. And in some cases, our clients are accepting it or not. But just going back, say 10 years, I think it took about 3 years last time for sellers' expectations to get in line with the new market. And maybe the new market is going to bounce back. Maybe I'm totally wrong. But I think it's about, look, last time it was about 3 years, and it's hard to tell somebody that they're not worth what they were before COVID, especially if they really don't have to sell to 55 and they could wait till they're 58. They don't really care. I mean, they care, but this was maybe if the administration changes, there'll be a big push to take advantage of the low tax rates. If there's an anticipation that taxes are going to go up, there's always externalities that force people to look at selling.
Right. Yeah, there are a couple of interesting questions that come out of that. So we've got a couple of questions that have come in here, and one of them we were discussing. It's actually sort of a polling question that we wanted to ask everybody. So Marisol, do you mind queuing up the poll question? And this one is about, whether you feel your company and institution is prepared to close a transaction without an in-person meeting. So curious to see what everybody says here. And thanks, Bill McNitt, for submitting that question. So we'll give people a second or two here. And Marisol, can we see the results of that poll? Wow, 42% said yes. Okay, so this is I would say this is a huge shift from even a month ago when, when I've had discussions with people in my network. Ken, want to cue it up to you. How do you react to this?
Well, I actually answered no, despite the fact that we closed the deal last week where we did buy a business from sellers that we had not met in person. So we had started a dialogue with two business owners back in February. Obviously, all hell broke loose in mid-March. We'd signed a letter of intent, I think the end of March, early April, and we're able to get it closed just last week. So a bit of a unique set of circumstances in that the two sellers, which is unusual for us, were not going to be staying involved with the business. This is a nutritional supplements e-commerce company. So we've been working with an executive in that industry for more than a year, pursuing a number of targets. So got a feel for his style, how he works. He was able to give us some great insight into a lot of the due diligence that we needed to do on the target. For many intents, it's a virtual business, just a handful of employees, outsourced, manufacturing, all product sales are online. We've been able to track their revenue through COVID on a daily and weekly basis. It held up and has continued to grow nicely. We're paying a very low valuation for it. We financed the deal with all equity, no lenders. So again,
this is a platform deal, Ken, right?
The platform deal, about 4 million of EBITDA, which is lower end of us, but good size. But
did the executive
everything
visit the
I
business?
cited. What's that?
Did your executive visit the business?
No, it was all done by Zoom and telephonically. So he's actually stepping in to become the executive chairman and has handpicked a team of people that he's worked with in the past to basically become the new management team of the company. One of the business owners is going to remain involved for a transition period. But again, a lot of things that I cited there were pretty unique and specific to this company that it actually worked out. But there's so many things. When I think back to looking at deals for the last 15 years, I can't possibly imagine personally with everything that's been cited, just the relationship, the rapport, the in-person due diligence on the factory or the distribution center, whatever it is. There's so much that you really need to do in person that, again, it's a fairly unique. I was surprised at the results of the poll that just under half said that they would actually do a deal. So
yeah, I was surprised too. Beatrice, when you're in, the processes that you have going on today, how are you, the traditional management meeting is in person, right? So how do you, are you giving buyers the flexibility to visit or keeping a level playing field with everybody? How do you sort of dictate that in-person meeting today?
Well, honestly, the ones that I think are going to close had already we're already in a letter of intent stage and everybody had visited. So, no problem. Yeah. Back on Zoom, that doesn't matter. And right. We have one deal that was in the market and we have 3 various use buyers and we've put that one on hold because the buyers want to visit in person and they can't. So it's just on hold for now.
Right. Dan, how about you? Have you visited any businesses or in this environment?
So we have not. I'm actually visiting my first company in 2 weeks. Ironically, I think 2 or 3 months ago, people would have said, you can stay in New York. We don't need you coming here. And now the shoe's a bit on the other foot in terms of the risk. Unfortunately, it's so but it's unusual. We're not going to many management presentations to be clear. We have closed 5 deals since COVID hit. So we certainly have situations where we say we have to meet management, and we have one deal in particular we're working on where it's on hold until we can sit down with management. But we've been able to close deals previously without meeting management. Unusual, but we find ways to get around it. And then interesting comment I had with a fellow lender who said he had an IC member that said they had done deals where they met management and deals where they didn't meet management as a lender. And he said he was making a case that the deals where they didn't meet management performed better because they weren't able to be sold by management, right? And the lenders aren't really aligned the same way with management as the private equity sponsor is. So I don't know that that's true, and I'm not advocating for not visiting companies, but I think it's way less important to us than it is to a sponsor. My private equity guys would say, to Ken's point, never say never, but it'd be hard for them to imagine closing a deal without an in-person management team and without several days of meetings.
Right. And yet so much of private equity is a partnership and forming a meaningful relationship effectively with your partner. So that piece is definitely a question mark. How about you, Doug? Have you looked at traveling, or is that sort of geographic dependent based on the location of the company? Where do you kind of stand on that today?
So we have a moratorium on air travel right now. It's on an exception basis, and I would say general business development would not warrant an exception. So we haven't really been on a plane since COVID hit. It's going to change though, because we're in that camp that we wouldn't close a deal without meeting management, and so I can see that changing here, shortly.
Yeah, I mean, particularly in a competitive process, and if other people are traveling, then you might just feel the need to do the same.
Yep.
But every firm is going to, some are going to be probably more sensitive based on their geography. I mean, if you look at the states, there's so much disparity in where the cases are. So that may dictate that as well.
We've had a management team take a road trip. So jumping in a car and going to see an add-on. So we've done a little bit of that, but we haven't really done much air travel.
Yep.
Can I just ask a question? Are you guys nervous about older managers?
That is a good question, and we've thought about it. So far, knock on wood, we haven't had any issues, but yeah, and we definitely have thought about that.
Yeah, I think based on the makeup of a lot of middle market private equity firms, you tend to have, individuals, founders, or more senior professionals that are in the more at-risk categories. So I think that's a good question. I think a lot of firms are definitely thinking about that. Let's see, we've got another Q&A question here about leveraging technology in this new environment. So curious what you all think about the advent of online deal sourcing, something that's been around for a while, but different people, depending who you talk to, have different reactions to that. Do you think we're going to be using more online deal sourcing and virtual deal sourcing?
Yeah, I think events like today, obviously everyone's trying to make do and improvise away from traditional in-person networking, in-person meeting with intermediaries, investment bankers, what have you, other sources of financing. And so by virtue of just needing to improvise and adapt, I think you will see more. I don't know that virtual virtual deal rooms like Axial and other kind of deal platforms, I don't know that will necessarily be more responsive or more utilizing of those sorts of platforms. I still think having a person on the other end that you can talk to about the transaction and somebody where there's a pre-existing relationship always helps. And having an online deal doesn't get away from everything we just talked about, the challenges of actually getting a deal closed without meeting somebody in person. So, but I do think the in-person, or sorry, the virtual networking events have been helpful. I've made a number of new contacts this way and seen some new opportunities that I wouldn't otherwise have seen. So I'm a fan of it, and it's not ideal, but we're all kind of making do.
Yeah, I like to think of it in the 12 months after this is over. So whenever that is versus 2 years later. And I think in that 12-month period, when people are still getting used to the fact that we don't have to wear masks and we don't have to social distance, whether it's because of a vaccine or it runs course, whatever the case may be, I think behaviors will change, you know, and this will be used. And, but I think, you know, kind of 2 years in the rearview mirror, once people have gotten back to something like not paranoid about being near someone without a mask, not paranoid about not sitting next to someone to have a meal, I really think the world goes back largely to the way it was, albeit some economic consequences to be sure. So I think that's the bigger implications to me. But in terms of routine and habits, I think we all want to go back to the way we were, and I think we will. It's just a matter of, will that be 12 months or 24 months after we get outside of this?
Yeah, I have to say, we'll bring in, you know, I don't know how many buyers for a particular deal, and it often, prices usually shakes out at more or less the same, and it'll come down to personalities and who the seller actually likes better. And that's a one-on-one. They came for dinner. I mean, everybody comes for dinner, but, you know, they had a good dinner, they had a good meeting. You know, who knows, whatever that intangible is that makes people like each other.
Right. Yeah, it's hard to have, we've had some Zoom conversations. It's hard to have that, you know, chat over a glass of wine, or even just having a chit chat, you know, on Zoom is not necessarily so easy. So that personal connection piece is tough. Have you all found in reaching out to your network that you have had more personal conversations and just kind of the catch-up calls, or has it been sort of strictly business?
I'll say, you know, certainly more personal connection and personal discussion, but I'll also say it's gotten to the point where I sort of start to find myself asking, do I need to still ask about their family? And I don't mean that in a way to be mean, but it's just sort of they know that this is just an icebreaker, and, you know, are we going to play that dance? And so I think we're kind of getting to that point where we're all used to the fact that, yeah, of course I'm concerned about your health and safety. Of course you're concerned about mine. We don't really need to say it anymore, you know, and let's start talking about getting back to work.
Yeah, I personally found that, you know, particularly in sort of March, April, May, you couldn't start a conversation without, you know, 5, 10, 15 minutes just sort of exchanging circumstances and everything else. So that is sort of adjusting a little bit as we, you know, we've all been doing it for a long time at this point.
And Nick,
so,
I'll put it a different way. When I ask people where are you these days, a month ago, they would say, oh, well, I'm here. When I ask them these days, what do you mean, where am I?
right. Yeah.
I've been for 5 weeks. So let's
Right.
get on.
Yeah. So, you know, Doug, I'm interested to hear about your structured equity and your non-controlled equity. Is that a, you know, as you run that group, is that a more of a focus today? Are you sort of increasing your efforts given this environment and perhaps restrictions around raising traditional financing? Has that been an increased focus for you?
Yeah, so the answer to that is no, Nick. That was the purpose of our fund from the very beginning. We felt there was an underserved segment of the lower middle market that was doing, you know, for non-control. These were businesses that needed an equity partner either for liquidity or for growth, but didn't want to give up or didn't need to give up control interest. So we raised the fund to specifically focus on that type of strategy. While we don't, you know, obviously we don't want to see people suffer and have a, you know, a poor economy, we designed ourselves to address this kind of a market. And, you know, there was a reference to rescue capital too. I wouldn't necessarily call us rescue capital, but it could serve that purpose And what it is a, when we talk about structured equity, it's typically a preferred security that comes ahead of the common in the liquidation waterfall. It's behind the debt. And we're starting to see some of these, and I think we will see more, where a lender says, hey, you're levered at 7 or 8 times and you really shouldn't be at that level. And it looks like it's going to take a while for you to get back to where it should be. So you really should raise some equity, pay down the debt, and give up some of the upside. And so for the right situations, that's our solution. And in addition to the equity, the companies get the full access to all of the Huron operating partners and all of our experience. So we become, a value-added partner without requiring control. And so it is a focus. It's always been a focus of ours, and we think that there'll be more demand here in the back half of the year as companies, struggle to get through COVID.
Yeah, and Nick, we've been. Oh, go ahead, Doug. I'm sorry.
No, that's it. That's yeah. Go ahead,
So
Dan.
we've been actively increasing our presence in non-control and junior capital. It's always been in our toolkit, but it's just, frankly, we didn't find it as relevant in the prior world. I think, our view now is we're seeing it firsthand in deals that we're working on is, I think in March, people thought June was going to be a disaster. It was going to be an apocalyptic quarter, and it wasn't. It was a really bad quarter. And if you had said to someone in January, your portfolio will be down 30% in June and you'll be happy about it, you would have said that you're nuts, right? There's no way. But that's where we are. Down 25% is actually pretty good because companies cut costs like crazy and got government stimulus. So that stimulus is going to eventually start being reduced, and those cost cuts, you can't solve a revenue problem forever. So I think we're going to see, rather than a big bang in Q2, a kind of slower moving wave of defaults as Q2 weighs on future quarters. And so in Q3, Q4, Q1, I think you'll see more defaults. And to Doug's point, I think you'll also see banks and other lenders start to normalize their behavior from the, we get it, the world's on fire. We'll give you a quarter to figure it out, to look, it's time to deleverage. The regulators are back. They're looking at our book. It's time to start criticizing loans and recapitalizing where we can. So we expect to see a steady uptick in this product and interest in this product in the coming quarters.
Great. I think I'd like to touch a little bit on the market, and curious about what your thoughts are, given the increase in cases in certain geographies of the country. Is that something that's on the mind of the investment committees of your various institutions, and how do you intend to kind of monitor the situation, as well as write additional checks in the next couple months?
Yeah, that's a good question, Nick. We went from a cadence of talking to each of our companies daily when things first hit and things were moving around so much, to 2 or 3 times a week, to now in most cases once a week. So we're monitoring things pretty closely, focusing on liquidity and working capital, and obviously expenses and PPP and so on. And I think things will normalize, but it is going to take a while, and obviously it depends on the geography of where you're located, and also what end markets you're in. So certain businesses are going to take a while to come back, and others have benefited. So we're pretty actively involved with each of our businesses today.
Yeah, I would add the same sentiment. I think from my point of view, I think 2020 is just basically it's a year of disruption. It's a lost year. I think getting the rest of the country. I'm from the point of view of a New Yorker. Obviously, we were at the front end of this, and now it's kind of rippling its way in a meaningful way to other hotspots throughout the country. But it doesn't feel like a second wave. It really just feels like more of the same, just hitting slightly different geographies. Luckily, none of our companies in the existing portfolio are in the current South or other states that are being more severely impacted. But to me, it just feels like, let's get through this smartly by the end of this year. Hopefully now we've got visibility into a vaccine, better antiviral treatments, and coming into 2021, I think it's going to look a lot like we had thought 2020 was going to look, back to a lot more business as usual, back to demand for our manufacturing businesses, our industrial products, whatever company it is. And we're basically just kind of set back a year. And this has been a year of survival. It's been a year of batten down the hatches. We've seen some remarkable innovation and perseverance from our management team, some great cost cutting, some very proactive sales and marketing strategies, some operational efficiencies that hopefully we'll benefit from longer term, and as much as we can next year. There's nothing magic about December 31st, but it just feels like it's going to take at least that long to kind of work itself through the rest of the country, with some of the other preventatives and treatments coming online, hopefully not too far into 2021.
Yeah, Nick, you mentioned earlier the COVID impact, and so how much of that do we understand, number one, and then the cost cutting, and is it sustainable, and might some of that come back into the system as the company starts to ramp its revenue back up? The third one I'd say that we wrestle with it at IC is just the economic implications of all this, and do we have any idea what the economic consequences of this are, as this, certainly the longer it goes on, but even if it doesn't get worse, do we understand really how this is going to sort of filter through the economy? And so that's the thing that we spend time trying to be honest with ourselves about, underwriting downside cases, making sure that we're comfortable that whatever happens with COVID from here, the economic piece as well, we're comfortable with the way that this particular borrower, potential borrower, is going to perform. That's something we try to just be very objective about.
I just want to add, so go back 10 years, and it was very interesting to see what happened, because we basically went into a recession. The economy contracted. There were certain firms that were winners in an industry, and certain firms that were losers. It wasn't always obvious to me who was going to win, who was going to lose. The ones that won generally took market share from the losers. The losers often went out of business, just went into 7. So you ended up with a smaller economy, but with a company that might be the same size as it was pre-2008, 2009, but was now much more profitable because they could put pricing up, because they were dominant in the industry when they hadn't been dominant before. So, I mean, you guys are much smarter than I am, but sitting here as a banker, I would be like, God, I have no idea which one to bet on. Who's going to be the winner here? You're looking at an industry. You want to rescue a couple of them, but it might be the third one that doesn't need rescue. That is the one that puts the others out of business.
It's funny because in 2011, 2012, even as late as 2017 and 2018, you were wanting to look back and ask how the company performed in 08 and 09. And I think you're going to see the same thing 5 years from now. How did you perform during COVID? And that's just going to be the rite of passage question all management teams are going to face.
Right, correct.
That's a great point. So I think we're just wrapping up here. Any final pieces of advice for our audience in terms of going forward with originations and business development?
Only to say, yeah, I agree. It's stay persistent, stay out there. You built up relationships, maintain those, because it'll come back to pay off.
Excellent, great. Well, I really enjoyed this. I hope those dialing in here today did as well. Thank you to all the panelists. Really appreciate it. And thanks again to Opus Connect and Lena for setting this up. I think at this point, we can conclude the event here. So thank you very much. And personally happy to continue the conversation if anyone in the audience wants to ping me. Feel free to. Happy to chat at any time.
Yeah, thank you, Nick, and Beatrice, Doug, Dan, Ken. Appreciate all of your insights and contributions to today's conversation. Definitely a relevant discussion. I want to thank our sponsors, as always, for their ongoing support, and to all of you for joining us today. We will be posting today's webinar on our YouTube, so look out for that. We have upcoming webinars you see here on the screen. July 23rd, we'll be doing a distressed webinar. And August 11th, we'll be doing a middle market focused webinar. So stay tuned for more information about that. I hope everyone stays well, and we'll see you soon.
Okay, thanks very much. Take
Thanks,
care,
guys.
everybody.
Bye.
All right.